Hey traders, welcome to video number 2 of how to develop your trade plan. In video number 1 we talked about the trade plan, why it's important, why you need a trade plan. We also covered section 1, which is what you trade. Includes your contracts or your product, your hours, your setup, and also simulation, why that's important. If you missed that one, you can go back to the archives and review that video. But in today's video, we're going to talk about risk-reward ratios and why risk-reward is important. And to me, I think it's the most important thing in a trade plan. So let's get started here. Section A, ratio. Okay, what ratio means is I'm going to risk X units to earn X units. Okay, for example, I would recommend never less than 1 to 2 ratio. Okay, but preferably a 1 to 4 ratio. So let's look at this. I'm going to risk 1 unit to earn 2 units, or preferably 1 unit of risk to earn 4 units or higher. Okay, now if you have a good setup or a decent setup that has a probability of or an expectancy rate of 60% or higher, then you have a good chance of being profitable in the business of trading. Now, why do I say chance? Because what you're going to learn over the long haul in trading is that it's less about your risk or your setup and more about the psychology of you, okay, and how you react. Because I can identify a 1 to 2 risk-reward ratio, but do you have the psychology to hang on for that 2? Okay, in other words, I can risk the 1, I can watch my stop being taken out, but can I get to that 2 or can I get to that 4 on the reward side of things? Okay, now the number of ticks to profit, let's look at this. A 1 to 2 ratio could be 4 ticks of profit to 8 ticks. Okay, or it could be 8 ticks to 16 ticks. It depends. It's derived off your comfort level for one, and also off of your account size. Now this is where I'm going to give you a big hint. It is a good idea not to risk more than 2% of your account size on each trade. Now you have to sit down and do some math based on your account size. Then you'll be able to see how much money you can risk on each trade and work that into the number of ticks depending on which market it is. And then of course that will also determine how many contracts you have and how big the stops are, and then how big your profit objective needs to be based on your risk reward. Alright, it's a good idea to follow that rule. Now the other part of this is for multiple losses. What's your rules on multiple losses? My personal plan says if I have 2 full losses in a row, I am done for the day. Okay, why is that? Because you never know. It could be volatility, could be I'm not in sync with the market, it may not be working good for my trade setups, etc., etc. So I am done after 2. Now I do get to come back in the afternoon and take a look, but most likely and most of the times I do not come back. I just turn the computer off and move on to other things that I need to do in that day, and you need to identify that for yourself. Okay, section D is volatility. When volatility raises its ugly head, and it will, some traders like that, some don't. When you have volatility, you need to identify what to do. In other words, I'm going to cut my size in half. I would recommend that if you are trading in volatility. What that means is if I'm trading 2 contracts, I'm going to go to 1 contract, and then I'm going to double the size of my stops, because if the market's swinging violently, which we've seen just recently, then you don't want to get taken out on a real tight stop, because you'll get taken out quickly and you'll be done for the day based on your multiple losses in a row. Okay. Also, another thing that you can do is not trade. A lot of people don't like volatility, so they don't trade it, which is quite all right as well. And then, of course, identify the trades per day, or the number of trades per day. Okay, your setup may be showing that you have 15 or 20 trade setups a day. I do not recommend that. Identify how many trade setups you're going to take in a day. 5 to 6 is probably fairly normal. Up to 10 is over trading quite a bit. And we have a rule: don't trade more. Okay, trade less and earn more. The top traders in this industry are trading a lot less, and they're hanging on to their trades, and they're earning a lot more. And I recommend the same too. So let's review this real quick. Risk-reward ratio: we'd like to see a 1 to 2 risk-reward ratio, preferably a 1 to 4 or higher. Okay, identify your number of ticks to profit based on your comfort level, but most importantly your account size. Do not risk more than 2% of your account size on each trade. Have a rule for multiple losses. 2 is a good idea. 3 is the max. Volatility: what are you going to do during volatile times in the market? Have your plan for that, and of course, how many trades are you going to take per day. So that wraps up section number 2. Look for our next section coming up here in about 3 or 4 days. If you have any questions, post them below. Hope it helps. Take care, guys.